Uh, the transformation from 0 to 1, it's not easy at all, I could say. So tell me few of the points for a 21-year-old kid who is starting with an idea on how to come from 0 to 1.
I would say 5 points, right? First of all, some things which I've seen people are able to pull off moment they put something on the pen to the paper.
So you told go on survey the customers. What is the right way to survey customers?
I think you made a very good approach, right? This is called primary research. You go meet the customer and get the input, and more the rejections you get is actually good for the startup at that juncture, because it actually opens up for tweaking the products. He also gets himself more refined to how to speak to your customer, right?
So if a founder comes to you and let us keep he has studied in a domain and he is working in a different domain now, but he is having an idea to create a startup from the domain which he studied. He comes to you and pitches up for an investment. So will you consider the skill which he studied and which he researched for the particular product, or will it be a red flag for you since he has worked in IT for 4 or 5 years?
No, not at all. See, there are many instances, and it is a very valid question, Leverson. Good that you brought it to me now. Since I visit campuses, there is a very good growing trend of people taking entrepreneurship as a career option, right?
Yeah.
And for some reason, they could have pursued some.
So what is the difference between a angel investor and a private equity or a VC in terms of the strategy that they handle or the risk they take?
See, broadly, these three actually is defined by the stage of the life cycle of the business only, mostly, okay, and the ticket size. But I see nowadays private equity and venture capital funds, the ticket size, check size is almost the boundaries blurred now.
Most of us have been speaking about startups getting a fund. So actually, there are even MSMEs and SMEs who are working on how can they approach for funding.
Briefly, on 16 years, worked about 4 or 5 years in the SME space and found this problem. Unfortunately, SMEs are stuck in between. They are neither startups nor the large mid-sized companies.
So we have been speaking a lot about the tech startups and tech companies, right? Where do you consider this AI is coming in?
AI is almost cutting across all the industries, right? If anyone is able to use AI very specifically for their existing domain and solve a large impact problem, then I think there is a solution. Otherwise, you also will become one more clone.
Firstly, good evening, sir. Thanks for accepting our invite for the Cascade Tape podcast. Initially, I'll set the context for this podcast. This Cascade Tape behind the scene podcast will be a one-point destination for any startup founder or a MSME or someone who is running a business about what is investment and what are the things there is an investment and where they should concentrate during their startup or a business journey. So before going inside, if you could just tell me something about yourself, sir.
First of all, thank you, Leverson, to have me on this podcast here.
Honors.
And you guys are really doing a great job, because this is a space that needs more attention now. Because as you all know, it's only the entrepreneurs who are actually building the entire nation. It's actually a nation building activity that you're all part of it, right? So congratulations for the effort and all the best for the journey. About myself, Leverson, I come basically with around 21 years of corporate experience. Of which 16 years have been mostly into the strategy and execution, where I have done mostly on the 3 to 5 year planning, execution of new projects, incubating new initiatives, fundraisers, M&As, and also startup investments. Since September 2024, I have started my journey on my own. I'm now currently a full-time mentor, a coach, and investor for startups and also SMEs. So I myself is now running a startup called Stay Still Scale High. So it's a very structured program for entrepreneurs. I basically guide them on two things. One, basically I come in at a stage of a life or stage of a venture where the venture has already come from 0 to 1, basically post revenue or post paid POC stage. And from then on, from 1 to 100, the journey. I'm there to handhold, because that's when the entrepreneurs need some kind of a support and handholding. So basically, I term is term that particular stage of building high growth business. That's the stage I come in. Yeah. Second, when they build a high growth business, there is a need for capital, particularly the growth capital. So I make the founders and the businesses investor ready through a structured program. When they become investor ready, when I am getting convinced that this is a venture that is investor ready, venture ready, that can create value, I also support them to raise capital. So these are the three major activities I do in my current journey as a founder, CEO of Stay Still Scale High Academy, Leversa.
Why you started Scale High? What is the motive for you to start your startup?
But that is because, see, doing these things for the last 16 years, right? After 21 years, 16 years, I've been doing this. I've been part of both sides of the journey as an investor and also somebody who is seeking investment. So I've seen businesses from, like I said, 0 to 1 to 1,000 crore company, where you are going to hit the market and doing things right. So I thought it is always good to have a structured program to do something on my own. Also, it has been in my mind for quite a while, where I have been part of large organizations supporting the ventures to do that. I thought the real impact happens if I could actually have a much larger canvas beyond the corporate where I'm working, right? So, and it also becomes a little more infectious when you start working with entrepreneurs, founders in the ecosystem. You see something happening before your eyes, and you see the impact happening before your eyes. It is infectious, right? So then I realized, why don't I start on my own? Because within a corporate, you only can do only so much, because there is a boundary within which you have to work, right? When you're on your own, you actually can expand your horizon. So it is more on that, expanding my horizon and expanding my efforts to much larger audience is possible when I'm on my own. So that's the intent. And second, I thought it's better to kind of um, structure the learning and give them in capsules for any entrepreneur. Like exactly said, a person who's aspiring entrepreneur from a campus is very different than somebody who's at 40s and 50s, having gone through a corporate ladder and then wanting to start up something on their own, right? The experience differs. But the young chap who's coming out of the campus has got a different energy, different perspective to the business. For instance, the current aspiring entrepreneurs where I'm visiting the technology campuses are digitally native um, uh, technology kids, right? If I speak about a drone and I throw open an opportunity for them, they are easily able to kind of grab into the activity of market opportunity.
Hmm.
Versus somebody who, a 40-year-old, when I'm discussing, he's thinking all about risk and what I could do to mitigate the risk. In the campus,
Rightly.
he's fully gung-ho about it. He gets excited. So the energy levels are very, very different. That opens up a new level of opportunity. But what the both set of entrepreneurs need is a structured approach to the problem statement. And they are all very, very good entrepreneurs. All they need is just a hand holding. So for which I thought, why can't I structure my learning into a capsule and then handhold them? And that's where the real fun is. So then that's the intent for me to branch out, start on my own. Yeah.
That's great. So, do you think uh, structuring? So, if I may have a B2B business, something like a service-oriented business, other person may have a B2C business running directly to a delivering directly to the customer. Do you think the structure for me and the B2C guy is the same? Can we create a individual structure for both of them, or does the
Yeah. So
structure
there are
vary from?
no, there are two levels to it. That's a very good question. There are two levels to it. There's a basic infrastructure level that they both are same, right? For instance,
Hmm.
the size of opportunity they are actually addressing is very common for both of them. The understanding of the customers, the depth of understanding of the customers is a need for both of them, but the degree varies. B2C approaches is very different and B2B approach is very different.
Of course.
There is a need of one basic need for execution capability, but on top of it, the approach is very, very different. So I would say there are two grades to it. The basic requirements to build a very high growth, high value business remains the same. The parameters remains the same, but approach very much differs. B2B is more scale very quickly and perhaps very less resource consuming. B2C is slightly risky because sometimes it is also like shooting in the dark. It takes
Hmm.
time, but once you pull off, it has a different value metrics also. So the approach for both the business is very, very different when it comes to structure. So one level is same, the other level is extremely graded.
Got the point. So what do you consider as a startup's potential success?
The startup's potential customer should be measured by the intent in which the startup was ventured out, and whether he has achieved it. Most of them actually pick a problem, right? I actually solved this customer's problem. If they could really achieve that, I think
Hmm.
that is the first quick win they are actually achieving, right? Because see, you can't define as a success because it's actually always a journey. But I would say like a quick win and a milestone. There are two things which I usually look at. So any startup which actually kind of ventures out to solve a problem for a customer, for instance, if it is a B2B person, maybe he wants to run a small ERP like a SaaS program for manufacturing companies, which is even cost efficient than any other ERPs like a SaaS ERPs in the market. I'm just throwing some example. Moment he is able to go to a few lakh, maybe a 40 lakh to 50 lakh kind of a annual turnover, small scale businesses also are ready to kind of download it, do it, and have a real intended benefit of this SaaS ERP, then he's almost having a quick win that there is a need for the product. Somebody is able to download and apply the product, and there is an intended benefit also of the product. That's a quick win. So I would say that's the first quick success of the validation of the business and validation of the technology. Otherwise, success is extremely subjective, right? It is a journey, right? So since you asked about startup, I think it is always good to have a quick wins, have that, achieve it, go to the next pin, achieve it, go to the next pin, achieve it. Then you kind of know do a chunking of your success on a longer scale, a larger canvas.
Got it. So recently, when was having a conversation with few of the startup founders, who are trying to build something new, who was not inside the stage of one, uh, the transformation from zero to one, it's not easy at all, I could say. So tell me few of the points for a 21-year-old kid who is starting with an idea on how to come from zero to one.
It's very simple, actually. It's a very simple structure. Maybe I think it's I would say 5 points, right? First of all, some things which I've seen people are able to pull off moment they put something on the pen to the paper.
Hmm.
Sometimes things are on the mind, and they're not really giving shape to it. So I usually, if I actually go to campuses, both in technology institutes and also B schools, and I work with incubators where I meet students or aspiring entrepreneurs by the scale what you're mentioned referring, right? They have something in their mind,
Yeah.
and they're all bold statements, bold problem statements. I saw somebody doing something in aerospace from a campus, which was something which was extremely bold compared to the relevant mindset we had when we were in campus, right? So they actually have very good thought and they know what they are speaking, but structure is missing. So I give a piece of paper to them and ask them to fill this 4 points, right? What is the problem they are trying to solve, right? And I also ask them to rate it in a need continuum, whether it's a need to get solved or it's good to get solved.
Hmm.
Need to get solved is a core need. Good to get solved, it's okay. Even if that is not getting solved, the business will
It's
still
not a
run.
priority.
It's not a prior. I wouldn't say it's about a priority. It's about a need continuum, and your
Hmm.
business can lie in both the extremes and within this extremes also. But moment you have this clarity, there are businesses built on both the extremes, very successful. But the approach to the business and mindset for this business is very, very important, very, very different. That you can't apply a good to get solved approach to a need to get solved and vice versa, right? So I request the students to put and push them to think through this need continuum, number one, because the
What is
pricing.
the sorry to interrupt you in between. What is the approach change that will be there for a need and for a good?
For example, very, very simple example, let's take, right? Let's take an example that if a startup is going to solve a problem for a core finance or operation need of a SME, okay? Just an example,
Hmm.
like a Tally ERP.
Okay.
If one day this ERP is not working, the entire business comes to a standstill. So it's almost like a core of the need.
Yeah.
Now you come to the other side, the same company goes for some time and it's want to launch as a loyalty program
Hmm.
with some memberships and incentives to the customer engagement. It is in a way compared to this relative terms, it's a good to get solved problem. And if one day it kind of know this particular loyalty customer engagement program doesn't work, someday it flunks, it doesn't mean that the business will come for a standstill. So you actually are lying in between these two examples, two extremes, right? And you can actually build a very successful um, uh, loyalty program business also can build a very successful core problem also, right? But the approach to the business is very different, because from a prior, like exactly you said about the budget priorities for the startups, for the SMEs, the customers, the need will be more here.
Yeah.
But after some time, this becomes mechanics. The ERP become a mechanic. There is nothing to do double done on it, right? It becomes business as usual. Then all their other needs grow up. So there is a scale for this kind of business to exist also. So when you are in a campus at the 20s or 90s or an aspiring, just put this continuum. And there is no good bad about where you operate. It's all about, are you right in focusing the right people, and is your approach to the business right? Accordingly, your resource requirement will change. The capital input will be change, will change. Your team will change, right? The mindset of the team will change, right? So that clarity you should have.
Mhm.
Because I usually see people that okay, I have this, I need a salesman. They take a B2C salesman for a BTP problem statement. It doesn't work that way also, right? Because it also needs some kind of approach and a mindset requirement. So that's number one. So being very clear about what problem you're solving and then where you need continuum, right? Second, that this particular problem is now getting solved by some already, right? See, there is not really a problem that is not even discovered. It can be, but generally in the campuses, people usually come with some space which where somebody is already solving the problem. Then I ask them, why do you want to exist at all? Because there is somebody already solving the problem, right? Why?
Yeah.
What is the need for you to come and exist? Because this question is very important. Then he will say, no, I will actually have such technologies. I actually have a easier convenience for the customer. I solve it at a cheaper cost. Then I ask them to go deeper into that, because this will actually help them to think beyond the obvious. He needs, he thinks there is a need for him to exist. It may or may not be the right thing because it's inside outside perspective. So after I actually ask them to go and meet the potential customers, at least 10, 15, to get their feedback and get validated also. So you first put your own thought, why do you want to exist? Because this problem is somebody solving the problem, right? You have to exist for a reason, what that reason is. Then as an extension of the second point, I actually push them to say, is there any strong differentiation they're building? Maybe because say the example of a ERP, okay? There is already ERPs like Zoho ERP, Tally ERP, and all the ERPs available for the that kind of a SMB segments, right? You're going to start. Maybe perhaps there is a reason, but it is extremely lightweight. And the data entry becomes so easy because of some kind of scanning in AI, something, or it's also visual and audio ERPs where you can speak and enter. I'm just guessing, giving examples to you, okay?
Got it.
That layer of differentiation that you're adding, how sticky are they to to make your presence meaningful, right? This will actually try gradually build into differentiation mode, because this is something which people miss, but it's better to kind of think in the beginning, right? Fourth is the opportunity of the size of the opportunity. Sometimes people go and build 10 lakh business. Sometimes people go and build 1 crore business. So what is your appetite? Would you want to build a 100 crore business or a 50 crore business or 1 crore business? Accordingly, choose your size and the growth rate in the business, right? So opportunity size and growth rate, they both are important. Finally, are you the one, or do you have the right team to execute it? The team execute it. After putting everything, I'll ask them to go and test the market. You have technology, doesn't have technology, you go speak to people, get an outside inside perspective. So if this structure is followed, which I have seen in the campuses, usually they come and then I sit with them for about 1 or 2 hours. They put that in the piece of paper. Then I just give them some time, and then they meet me again, maybe 15 days, 20 days, or 1 month, depending on the requirement. Mostly people have a extremely good quality of thinking, and they usually kind of go back and say that I'm going to plunge into this, or I'm going to do some edits and then go plunge into it. But they're mostly well prepared.
Got it. So when you are speaking about the second point, find are you actually product market fit kind of thing. So you told go on survey the customers. what is the right way to survey a customer? Because I have a experience where when I went to live potential market and I asked for a product, will you buy it or not? Literally 50% of the people told uh, they will buy it for sure. Okay, but when I made myself when I asked few more time to them and I explained the product entirely to them for 3 or 4 minutes, I literally got a 30 to 35% people only accepting the product to buy. Remaining 50% was not even ready to buy the product. So here, if I would have taken the first sample as actual sample and I went to building that product, it would have not been worked out, right? Because I would have not actually attending making a product which is market fit. But since I made few more time to analyze the customer's mentality, I could find the actual market for that. So what is the actual right way to take a survey to a customer?
I think you made a very good approach, right? Primary, this is called primary research. You go meet the customer and get the input, and
Hmm.
more the rejections you get is actually good for the startup at that juncture, because he it actually opens up for tweaking the products. He also gets himself more refined how to speak to your customer, right? See, many of this uh, um the students, at least aspiring students in the category which you spoke, may not be good in articulating what they wanted to do. They are more technology oriented. I also met many technologist
Hmm.
ventures. They're very good in technology, and when they speak to the customers, potential customers, they speak more on technology. They don't really go into the outcome and the benefit that the customer would understand. Get me right? So maybe that could be the one reason, right? But even if it is 50%, 70% people are saying no, I wouldn't buy, or I buy, that's a good experience to have. So there is no second thought that you should not do it, you should do it. Now, coming to your point about specifics about what is the right way to do, uh, when we go and speak about a concept, you speak from a different plane about your product, right? But the customer is always looking at from his problem statement viewpoint, right? Perhaps you were not able to really touch the right nerve and explain him. That's why you could have said no.
Yes.
That doesn't mean that it is actual no. Number one. Number two, somebody could have said yes for the sake, okay, they understood. But that I'll also not take that as a full yes. What is the asset test for it? The litmus test is very, very simple. Litmus test is to kind of know, come back to the actual drawing board, do something, and go and meet the same guys with some kind of a minimum demo, minimum MVP, minimum viable product, right? That time they get an idea about what you, even the one who has said no to you, go and speak to him. See, is there anything that I could do on top of it, right? So when you do the second level, you're actually demonstrating what you have thought in the actual product and going to say to them. Now the litmus test is that would he accept for a paid POC, or would he pay for something like this? Till the time the discussion has been more transactional, right? He is just giving input, and most often people are very open to discuss and engage and give input. The break of the engagement comes moment he asks for a money,
Oh, yeah.
and I actually pushed to that extent also second time when they go, because when they say yes, people take it as a market, but when you ask people to pay money, there is no market.
It is a different thing entirely.
Yeah. So there is something called willingness to pay. It's called WTP, we call, right? At what level the person is willing to pay. That's the reason I'm saying when you solve a problem which is good to, which is need to get solved, and with a good layer of degree of better from than the current existing solutions. Sorry, very good degree of differentiation than the current existing solutions. Perhaps actually touching the right nerve to trigger the willingness to pay, and you will understand the discovery of the pricing also. This is very, very important.
Got it.
Discovery of the pricing and willingness to pay and what level they pay is more important. So yes or no is more like just a dip test. That doesn't mean that they're going to buy, or it's basically willingness to pay is a real test. Get me right? So I think the second time you go, even you said no, yes, you actually need to kind of speak to them and ask for a paid POC.
I get the point, right? Precise. So, you being an investor, uh, if you're evaluating a startup, if someone is pitching to you, what will be your red flags that you will walk out from the business?
Uh, I think most of the pictures which currently, thanks to the ecosystem, are far better than what we used to receive 5 years ago or 3 years ago, right? People are now having enough resources, so people usually come with a slightly better structured picture. So that way, it is far good. Uh, uh, Nose would be because the size could be the opportunity size of the particular startup would be too small, and it may be in a micro market. And when I push further and when I ask if the founder doesn't have a viewpoint, how big? See, you can start a small micro market, no harm in it, but there should be some visibility and a point of arrival for addressing a larger opportunity and becoming large at some point of time. Because any
Hmm.
investor who's coming in wants to exit at some point of time, particularly after 5 years. So if somebody has to come and exit at 5 years, he has to have a business which actually is more saleable at 5 years, so that somebody comes in and he gets an exit. So I would look at that perspective, whether there's a good opportunity size, growth rate, both has to go hand in hand. That's where the magic is. And I will also actually go second level of how has the startup or the founder evaluated the market opportunity. Most often they go to the chat GPT or they go to any of these published reports and say that I'm addressing a 200 billion US dollar opportunity or even 1 billion US dollar opportunity. It doesn't make sense at all, because you're just starting, and that's a very large opportunity existing in the air. So I see whether the founder has gone on the ground, done his research, and really have got a sense of the opportunity from bottom up approach. If he says, you know what, I did speak to people and I have come with an opportunity size of 200 crore than 200 million, it makes more comfortable sense for me. Okay, he actually has got a sense of opportunity which is grounded, which is maybe around 100 feet viewpoint rather 50,000 feet viewpoint, right? So the founders ability to have a granularity of understanding about the opportunity and the customers is something which I evaluate. If that is not there, I actually support. So if the opportunity size is not large and there's no growth rate, support. If the founder has not got a grip about the problem statement and the opportunity size, I support. Third is the differentiation. See, you can build a startup and you can be one among 1,000 startups or one among 100 startups, and you get their a seed money or a angel money. But unless you became in the top 10 league or top 5 league, at least you have a path to do that. I don't think you should become immediately, at least the approach to it, that I have got these 4 or 5 differentiated points through which I can actually have a leap of growth. And that actually will give a delta for my valuation, right? Today I come with around 5%, 10%, 15% dilution for the startup. And if that particular startup demonstrates that he is going to be a potential leader, then there is a delta for the risk I take in the early stage, because it's mostly early stage startups is illiquid investments. Most of them wouldn't go for the next level, and it is not going to exit, right? So I look at whether the founder and the startup is building enough differentiating points, which actually gives a delta for the valuation and for the investment that we make. And at least that's easy having an approach to do that, right? Finally, the team, the founder and the founding team. Does he have the complementary skill set? One single founder can't do, right? He can be a technology person, he could be a good a sales person, he could be a thing, but does he have at least a mindset to build a complementary team, even after funding, not immediately after funding, right? And worst case, if he is able to convince and sell his idea to the founding team and just give an equity without even salary, then he's a very, very passionate entrepreneur who's able to sell his passion to the co-founders, and without even paying salary, he's able to kind of onboard them. I've seen founders who have actually taken places on rent with not paying rent at all. He'll say, boss, once I reach a stage, so he's able to kind of make his passion infectious to the other person and able to kind of sell. That's the first salesmanship, right? So the founder's potential is he's a good person to bet on. These are the 4 things. One complete red flag, which is no, which I think is completely a non-negotiable, is the integrity of the founder and the founding team. If
Okay.
there is, we find something which is not congruent to what he speaks and what is putting there, that is something immediate red flag. You get to know, you get the sense of it when you speak. And maybe if not in the first interaction, second, third interaction, you may think it's not congruent, there's integrity issue, then I think there is no discussion at all. Other points, is it better that you speak to the founder? If you like the founder is a very good person, and if he's open for coaching or mentoring, you actually can solve the other problems perhaps, but not the integrity problem, right? That we never know. So that's other red flag. Otherwise, the other 4 points, if they are actually going in the other in the green zone, mostly I take it further and go further.
Great. So I have a situation like this. So if a founder comes to you and let us keep he has studied in a domain and he is working in a different domain now, but he is having an idea to create a startup from the domain which he studied. So, for example, if he is an electrical engineer, but he is working in IT. Meanwhile, while working in IT, he is creating some idea related to an electrical engineering. He comes to you and pitches up for an investment. The fourth point which you mentioned about the founder's skill, right? So will you consider the skill which he studied and which he researched for the particular product, or will it be a red flag for you since he has worked in IT for 4 or 5 years?
No, not at all. See, there are many instances, and it is a very, quite a very valid question, Leverson. Good that you brought it to me now. Since I visit campuses, there is a very good growing trend of people taking entrepreneurship as a career option, right?
Yeah,
And for some reason, they could have pursued some discipline in their engineering or in their graduation and post graduation, and they could have gone to some other industry, maybe out of interest, and then they want to come back to the other industry. That's all fine, right? And after 4 5 years, most often people want to start up on their own, either in the new experience they have gained or the old experience, some idea that has been. I have seen engineers starting a QSR restaurant chain, right? There is no connect to that, right?
that's a
He didn't
fancy
study
business now.
a fancy business. And no, I have seen engineers starting farming business.
Of course.
Yeah, so I know engineers, extremely well-read, Ivy League kind of like campus engineers, getting into farming because to infuse technology into the farming, right? So it's all about not the. It may be good to have the same discipline, but it's not the requirement, right? If he is able to demonstrate the passion and also translate the passion into execution capability, perhaps he doesn't have immediately, right? He may go do some internship, interning in somebody and get an idea, or he can bring in some valid partners. I also met a couple of one founders who was a pair, where one person is cracking something in real estate based technology, and is a tech person,
Okay.
has no idea about real estate at all. Just because his other co-founder is from real estate, he's venturing into the real estate of the technology. But when I push them further, maybe the same application can be done in some other manufacturing industry. The pricing could be different. They're open. But then the other person who had a real estate industry shrugged off and went to the manufacturing industries and did some POCs and pilots also. So it is about the openness and
Hmm.
agility of the founders to suit the requirement and make it successful, right? So at the end of the day, whether he is able to pull off, period. He can be a domain expert, he need not be a domain expert. Of course, in deep tech startups, it may be a necessity for sure. For instance, somebody is building something in a drone space, and the none in that and the group doesn't have anything about drone, then it's a strict no.
Okay.
But you actually can build a complementary thing. The more it becomes deeper and deeper, it's better to have a very strong domain person, either as a founding group or as a co-founder, and it's all fine. But if you're able to pull off with the right complementary skill set, that's fine.
Got it. So I'd like to split the problems of founders one by one from 0 to 1 before going to 0 to 1. Now, first we spoke about validating the idea and making a product market fit. And once creating an MVP and getting it tested from a customer, now he's having a valid customer. He came to the investments with less number of red flags that you already have, and he is created it. Now, the next question comes in is he's working in a company or something, and he's creating this idea as a individual part. He has to step in to create start his startup. So that's where he comes for investment, right? What happens at the stage of investment, after the stage of investment orders? And secondly, if he is coming inside investment, so he would, most of the people who doesn't start a startup have a problem that they're having a commitment for their own salary. So how long should he run without a salary? or is there something else in the investment that is covered as a salary for him?
So first of all, when somebody wants to start up after having a career path, right? It is basically the drive to be on the own, which is basically driving him to become a startup founder, right? And but always salary gives a good safety net, and also he may have commitment. That's one of the reason I see in many of the campuses, people step out and go for a job or corporate, take a corporate job for 2 to 3 years to kind of ensure that commitment is done. Few people come back, few people go into the same journey and never come back to the startup world. That's all fine. But when you startup, please have an idea to have enough buffer to take care of your regular needs minimum,
Hmm.
because you will burn out. It's a very it may look very attractive from the outside world to put a LinkedIn profile as a stealth startup founder, but reality is very different, right? Because money doesn't come
Of
just like
course.
that. So my request is that when somebody wants to kind of step out into that particular thing, you are actually willing to taking a step out of the comfort zone. Great, hats off. But please have some kind of a buffer for you to. I call it like a working capital problem, right? I see many of the founders start the business, plan everything on the technology, but they don't have money to run the business. Similarly, if you don't have money to run and be comfortable as a person on your family or for yourself, then you'll burn out, right? So my request is to kind of at least have some buffer plan for it. So when you want to start up, at least plan 6 months in advance or 1 year in
Hmm.
advance. Gradually have some kitty built for it, at least for 6 months to 1 year. If something goes wrong, you actually always can go back to the role, and you can make yourself uh, readily available for some kind of a corporate for getting in the employment world, right? But till that time, please have that plan for it. Build a kitty. So something like people are building for their house, for the marriage, for the education, right? Similarly, anyone who's aspiring has to build that. Number one. Number two, there are a lot of options on incubations and grants available. It's all open up, right? So according to your thing, please keep an eye on it and keep applying for them consistently. Most often when you go on the pitch and get an opportunity, it is going to help you on 2 3 things. You're going to sharpen your proposal further and further, because you're going to get multiple questions from different dimensions. So it actually sharpens your thing. Perhaps you'll be able to crack some funding to initial things, and get tapping into the tapping mode of grants also. And please be aware that getting a grant and getting the money in the bank is two different things. There may be
Hmm.
times of for it also. You may get a 30 lakh rupees grant approved, but money would actually come after 60 days. So
Of
you should
course.
not read it, the 30 lakh is with me in my bank. So there is always a cash flow problem. So ultimately, cash is king, be it a business which is mature or in the startup side. So if you're a founder, think from the cash angle. Do I have enough cash, liquid cash, or in any other form, which actually give me a runway of 6 months to 1 year? Yeah, for which you do, and go tap into the grants first. Don't go for equity investors initially. You go for the pitches, but tap into grants first. Get that first. Go
Hmm.
get into incubation program and get incubated in some other campuses and get a workspace done for you. Get me
Got it.
right? Do that. Then I think you are a little safe. Then you focus on the business. You at least sorted out on the other issues, right? You need not really go for a, because there is a co-working space in an incubation center. You can go there. If you don't get also work from your house, that's all fine. But go tap into the grants and other prize money is available. Go keep pitching to them so that you get the first level funding done for you. Then you have
Got it.
something tangible to the equity investors. You land at a different discussion, because in this current world, at least scenario of equity investments, people usually look at least POC stage, a minimum viable product stage, and a paid customer stage, right? So till that time, assuming somebody says only I can only touch you only if you come there, then you need a time to kind of run the travel from zero to that particular space. It could be 6 months or 7 months, right? So you should plan for it. So it's almost like a extremely well planned game plan before you venture into it. Please do that. If somebody wants to do that, maybe touch base with some other founder and discuss with him and get the
Clear.
plan done and then go into the thing. Just like the out of impulse, don't or looking at the LinkedIn post or Instagram post, just don't take the decision. That's what I would want to say.
That's clear, sir. So now when C comes inside, what are the type of investments there? If you get one line for it, and at which stage he should consider the each type of investment.
I would suggest that if you have a idea stage till the MVP to the paid POC, please try to tap into all the available grants for you.
Okay.
Please exploit that particular grant ecosystem completely. And also, I said that the grant ecosystem and the incubation ecosystem is it's actually growing in the country. So you need to be mindful about tapping into them. But there is always a time gap between the grant approval and the money in the bank, so you should be mindful of it. That is something which I am just giving as a disclaimer.
Yeah.
Say I have got a paid POC level. It is depending on the startup side. For instance, something which is a medtech deep tech startup, a deep tech in medtech space. See, for them to get commercialized, it's a very long game. They may have a very specific investors who actually will come in at a paid POC stage also, because they are actually tuned for it, right? But if somebody is doing a very simple AI applied productivity improvement, business process automation, something like that, okay, for which people will actually ask you to prove the business, get the paid customers, and ask money only for the scale up. Because investors are actually, because here it's a duration of the business to get from 0 to 1 actually can be shrunk if you actually have a good product market fit and you're able to market it, or if you're able to close deals, you can win it. So ultimately, it may become a B2B sales problem than a technology problem. But in a medtech, deep tech startup, he may have other regulatory approvals to take, right? So there may be a little longer gestation. So there are some class of investors who look at differently. So you need to kind of get your slot properly done on the what kind of startup you're building. So go to the equity investors at the right point of time. Once you have something as a paid POC, even if you think that they are not going to write a check, please keep speaking to them, because they will give you the milestones. They may say, you know what, you are really building very good. Currently, your run rate is close to about maybe $100K US dollars for the entire year. Just scale this to 250K to 500K on an annual run rate. Maybe I look at you. Then you know what he wants, and you build your milestones accordingly. Somebody say, you know what, in your client list, I don't see any small and medium enterprises. They're all very, very small guys. Go try cracking 4 or 5 logos in this. I'm willing to kind of look at you. Then your milestone is set out like that. So please keep engaging the equity investors in parallel. And they may be right, wrong. That's okay. They may be right, wrong in their judgments.
But
That's
we
not
have
an
to be
issue.
keep engaging.
But keep in touch so that your milestones, your plan is set accordingly. You at least have a external validation of your business problem and beyond your business.
Got
So
it.
one thing, then go for an angel round or a seed round. Once you want a $500,000 to $1 million US dollar, more like a growth capital to scale your existing model, then I think you'll have enough and good options. You'll be able to crack it. But so far, so good. Then it becomes an inverted funnel. Henceforth, the people who go for the next round of funding, for a venture capital funding and other things, the market becomes extremely tough now, because you have to be now proving your leadership and the ability to kind of now say that I am a tad above than others, so that I can become a leader. Because venture capital funds, they look at exit, right? And they come at a different valuation also, right? So now, thanks to SME IPO, people are also reaching a very decent size, assuming somebody has a potential to become a 50 crore with a good PAT and all this stable business, though they may be just 5 years, 10 years old, they may tap into it. But but be mindful about, once you crack an angel round or you crack a grant round, that doesn't mean that you have passed to, you have a visiting card to get into the other round. May not be. Here the real asset test starts. You need to really prove what you kind of put in the pitch for the angel to come to fruition. Only then you will tap into something. So it becomes an inverted funnel after that. So that's why you see a lot of exists that happen in the angel round, and it becomes illiquid for the angel investors. That's why I said about this 4 or 5 topics which I said when I evaluate. I evaluate on the differentiation, why this startup need to exist and what can be the potential leadership position, because that determines my exit as an angel at that stage.
Got it. So, what is the difference between a angel investor and a private equity or a VC in terms of the strategy that they handle or the risk they take?
See, broadly, these three actually is defined by the stage of the life cycle of the business only, mostly, okay, and the
Okay.
ticket size. But I see nowadays private equity and venture capital funds, the ticket size, check size is almost the boundaries blurred now. We used to speak about 5 million, 10 million, 20 million check sizes for a venture capital fund. And these guys are even now writing larger checks also, which PEs used to write some point of time. Early stage PEs used to write some point of time, right? So there are something called late stage VCs who are almost like PEs, right? So check sizes is one determinant, but apart from that, it's mostly the life stage of the company or the business that makes more sense. So let's kind of first discuss about the early stage investors, right? Angel and VC. In my mind, again, it may not be applicable for the complete canvas, but broadly, angels come, like I said, at a half a million to 1 million US dollar kind of a, or even 2 million types, right? To that, and they would want a proven model, a proven technology, proven business model, and they come in to kind of give the capital to help you to scale further. This
Okay.
is see you, okay, you've done something and you're proven, you actually are actually a venture capital fund, because now you're venture ready. You're now ready for a next 10x growth. I'm come there and I'll kind of help you there. Yeah. So as a founder, you should be mindful about the who you're taking from who you're taking the money also. Because money is important for you, fine. If possible, choose the right investors also, because it's not only money is going to help you. You need money. You need people helping in venture building. You may need people in mentoring you. You may need people to open doors for you. So just keep an eye on possible. It's not always a possibility. If there is a possibility, choose the right investors also, whom you're taking in your cap table, so that they can actually help you to hand over for the next level of growth. So when you go to the VC round, also choose according to the VCs accordingly. Just don't go tap only for the financial capital. Good for take for network capital also. And is he going to add me for the next level of growth also? Have that mindset since beginning. Even for the sake of incubation also, choose the right incubator. If you're deep tech incubator, just choose the right incubator who has got a good deep tech ecosystem thing. Just don't go and incubate in any incubator who is willing to offer incubation. You be choosy about that also, because that actually will help you on the entire life journey, right? So coming back to the same question about the angel and VC, it's about the life stage. PE is not about a stable business. It's
Okay.
only after you reach a stage you're profitable, it's about the next level of growth, right? So I think angels is extremely a different, actually far away from a piece in that sense, right? So in terms of evaluation criteria, all of them will actually almost have the same topic. Are you addressing a very large opportunity? Because now problem statement is gone. Because angel, VCPE, if you're coming stage, maybe at that stage your problem statement is validated, right? How big is the opportunity and what is the growth rate? Because each of them has to kind of pass the mantle to someone and get an exit.
Hmm.
And they look at 10-year plan, not 5 year. Is this going to be a 5? You can actually go and sell that in 5 year, I can become so and so, and market is also so and so. No, they look at 10-year horizon, because they have to go to stay with you for 5 years. And after 5 years, they have to sell the idea to the someone who's going to come in them.
Hmm.
So if you have a 5 year horizon and there is no visibility meaning not about the business, about the market, I'm saying. If the market is extremely myopic in terms of the growth journey, then they will have a trouble for exit. Today you are good. After 5 years, they may get an exit issue. Get me right?
Of course.
So size and growth rate is extremely important for all the investors common. Second is the key difference between these three is that because the life stage is very, very different, pieces and angels bet more on the founders. P is better on the management bandwidth beyond the founders,
Got it.
because by that time you should have actually built enough second line. You can't be only the smartest person in the table. You should have built in enough time, bandwidth, the depth and the width of your bandwidth of your management bandwidth, that they will value more. The initial stage is more about founding and founding team, because you are the one, right? So that's a big difference between these two. Apart from the life stage and the exit, and also the investor return expectation, everything will be different on the risk side, because at the PE side, risk is slightly okay, because not completely going to kind of go into the drains. But VC and angel, there's a possibility he can never get an exit also, right? Because the startup would never go for a next round of funding, or the promoters may never be able to give an exit by buying back their shares. So the stage of risk is also extremely high in the initial stage.
Got it. So, which means VCs or the angels actually focus on the founder's capability or the team's capability, and the PEs think a way beyond on how to hand over the exits and how the management is actually running with the
Yeah,
entire
they
structure
actually
of
would
organization.
want, yeah, sorry. So they basically, you're gone with that early stage, life stage, right? So you're
Hmm.
no more the kids block now, right?
Yeah.
You're now in the mature stage. So now they would want that how the company has enabled technology, how has how is the governance, right? Okay, one common thing across all of them is governance. Like I said, integrity.
Hmm.
All of them put a very, very high grade of evaluation criteria for governance. Governance meaning, how is the reporting? Are you complied with the regulatory requirements? For instance, if you see, a lot of things happen in the fintech space in the last 4 or 5 years. People got into something without even knowing that there is a regulatory requirement, or they
Yes.
got into some space which is very gray. They took a risk, but the gray became black and white, and they got caught in the wrong side also sometimes. So the regulatory compliance requirements is extremely non-negotiable for all the stages, but becomes extremely non-negotiable at the angel, VC, and PE. Early stage, at least you don't know, because it's just shaping up, but you should actually have a mindset for it. But PEs, it becomes extremely high also, because for them, sometimes I have seen in some of the investments, even if the growth rate and other things go for a small deviance, they're okay. But if governance go for a toss, it is a high red flag for them.
So, most of us have been speaking about startups getting a fund. So, actually, there are even MSMEs and SMEs who are working on how can they approach for funding?
Yeah, I have briefly on the 16 years worked about 4 or 5 years in the SME space and found this problem. Unfortunately, SMEs are stuck in between. They are neither startups nor a large mid-sized
Yes.
companies. And obviously, they may not be in the stage of VC funding at all, because VCs have a different mandate in terms of investment. So now, but fortunately, from the last 5 6 years, the SME IPO space has really opened up, and there was a lot of noise. And currently, if you see in the last a month, a lot of thing has got settled. Also, the hype has got settled, and things are in a normalcy. In a way, it's good for the market. Yeah, but if an SME, the view with SME is that SME is a definition, right? One is the definition by the statutory requirement. There's so
Okay.
much of net worth, so much of revenue. That's, I'm not referring to that. I'm referring from the mindset of SMEs, right? Startups since beginning have this mindset of taking money from outside. SMEs since beginning, they could have built their business. After some time, moment it comes to taking money from outside, they have uh, maybe an uh, I would say, I wouldn't say resistance. Maybe they need more awareness about it,
Hmm.
because so far it has been always within the family.
Okay.
Now there's an external investor coming in, and sometimes they may not know the risk involved and also reward involved in the taking money from outside. So they need to have that particular mindset thing crossed. Number two, moment you go and get a equity investment from outside world, there are also small SME focused PE funds also available now, writing a small check size. But let them be. There should be
What will be the average check size for them?
no. Moment it is even SME, and one basic criteria here is that larger check size is good for the fund houses.
Okay.
Uh, For instance, if I have 100 rupees,
Hmm.
I would prefer to do for 250 rupees investment and manage only two portfolio than doing 10 rupees investment. Get me right? Because I am a very thin I'm a thin fundos. Every fundos has got a principal and their own investment analyst team, but they're not a company of large size.
Yeah.
So if they see with two good bets for 50 rupees and they can deploy, they'll be more than happy than deploying 10 different rupees for 100 rupees. Because the
Got
kind
it.
of bandwidth needed for making a 50 rupees
For
investment
analyzing.
is almost same.
Yeah.
You write 10 rupees check, you write 50 rupees check or 100 rupees check. The same amount of effort, time, bandwidth, and post putting money. Think about managing the portfolio. That's extremely tough. And then you have to find an exit also. And then give the money back to your own investors also, right? So anyone who's approaching a fundos should actually have this in mind. Yeah. So coming to the check size, I think decent more than for 20 million US dollar is a good check size. Less than
Okay.
that, it may not be a good sweet spot for most of these people.
When you tell about having a larger check size is safe and for the investor perspective thing. When you have multiple funds, your percentage of failure is also divided, right? So even if one survive and the remaining nine fails, you can manage your fund house with the one which is surviving. But if a larger check size is there with the funds that you're having, if one fails, your half of the fund is vanished, right? So in terms of this way, will it be good for the fund houses?
But that's a very valid question in terms of diversification of risk, right? Putting the
Yeah.
eggs in one single basket problem. It's always a trade-off between that and this and that, right? See, for instance, um, like exactly said, I took an example of 2 versus 10, but every fund has its own mandate. For instance, assuming I'm going to play today in a
Hmm.
manufacturing SME space,
Okay.
and each of these companies are going to become are mostly at 50 crores to 150, 75 crore to 100 crore kind of a revenue size.
Hmm.
What will they do with the 15 million US dollar funding? They don't need that money or they can't consume that money. So if I'm going to start a funding fundos now, basically going to deploy the money, maybe I take a call that my check size is usually around 20 crore rupees.
Right.
And I define my market. So I am going to look at manufacturing entities in different clusters. Various textile cluster, automotive cluster, IoT clusters, right? A pharma cluster, a leather cluster. I go there and pick
Hmm.
guys like this who are potential mid cap and large cap investments for the IPO round. They
Hmm.
need only 15 to 20 crore, 25 crore as a growth capital to make them in high growth path and become investor ready. That is a call I can take. Then I have 100 crore fund and divide between 5.
Okay.
Possible, right? So it's
Yeah.
always about space and the mandate they take. I gave it as an example. I take your
Hmm.
point, it is good to kind of diversify, but at the same time, it's a lot of bandwidth.
Right.
So it's a trade-off between how much risk they want to rate and also the mandate they carry to deploy the fund.
Okay.
And also the opportunity size available. For instance, again, as a startup founder or somebody as an SME, you need to understand if you're going to go pitch for your funding, you please be aware you're not going to compete for that particular funding for a parallel company. That particular fundos or the investor will actually have multiple proposals from different industries having a better returns than you.
Right.
So it also depends on the stage at which the particular fundos is playing, right? Maybe today, if he comes to a space of SME, he may get a more opportunities at a 20 crore bandwidth. Maybe 5 years ago, he could have only got only more than 50 crore opportunities he could have got. So the
Hmm.
stage of the people who actually take. But yeah, for a question to answer the question, it is always a trade-off between the diversification of risk versus the bandwidth. At the end of the day, it's also a resource, right? There is a small team. They have to kind of deploy the same capital in 5. That is okay. Then after that, you managing the portfolio and getting an exit is a very big problem.
Yeah.
For the sake of risk avoidance, they may get stuck in all the 5 also because they're not really efficiently managed everything. Possible, right?
Yeah, that's clear. So what industries specifically in SME speaking about has more highlight and a pull over for the investors?
Currently, what's happening currently is, given that a tech space create a lot of noise and all those things. Currently, at least when I speak to the investor community, it looks like it is more about very solid manufacturing companies
Hmm.
addressing the consumption story, right? Or even B2B, B2C, but consumption story have a very good, at least in, because they can see things before them. There's a plant, there is a manufacturing process and all those things, but there should be good scalability. And the founders, the team actually can become all that I said for the initial investment applies here also. Large opportunity, growth size, good team, potential to become a leadership in the particular space. You're not being 1 in 100, you should be 1 in 5. Then you have better potential to kind of grab, because these SMEs, when they take money, the investors would want to go to an IPO to get an exit. For an IPO, they should have a very good story, right? So, in that case, the manufacturing businesses and any technology business that is enabling this
Hmm.
is also something which is good. But pure tech, I'm not very sure at this stage. Maybe they may wait and watch. But at least for the investor community where I'm in touch, there is more interest on manufacturing and also tech-enabled manufacturing or tech enabling the manufacturing, something like that.
Got it. So I see most of the MSMEs as well are in manufacturing unit with an assumption. Uh, and if you take a startup comes in with an idea as well, right? So MSME can be someone who is having a couple of lathe machine and having usual orders and running it. Now, considering the case of MSME, you will have the same amount of competitors as well. I mean, a larger amount of competitor compared to a startup's idea or the USP that they have, right? So, how will you evaluate an MSME in this case?
No, so run-of-the-mill ventures which don't have any entry barrier, it's very
Hmm.
difficult to get a equity funding.
Okay.
They may get a bank funding, they may get very specific incentives of the government, that's all fine. But if you don't have a very strong differentiator, for like you said, you go to some one cluster, there are 50 people doing the same thing on
Yes.
all same size, 50 crore companies, right? But technically, if the founder has got a better hunger for growth,
Hmm.
somebody becomes a tier one large size company and leaving others behind, right? That's a possibility always. It was a possibility for all of them, but
Yeah.
some took the choice of that route, right? So if SMEs and MSMEs are clones of multiple businesses, as a cluster, they may make more sense. But for an equity investor, coming in and getting an exit would be tough.
Got it.
Because what story I have to get an exit, right?
Hmm.
That
Right.
delta I said about the value accretion is not possible when you are actually a clone of 50 people. Rather, I put the money in something else.
Of course. Precisely. So, what are the risks that an SME take in terms of funding when they're getting an external funding?
No, I think it's not about risk, it's about preparation. I would say that's, I would put that way. It's not about risk.
Okay.
Preparing mentally, emotionally, and also from terms of operations and governance, you should be getting prepared for it and having some awareness about it. Equity investors come with their own. So far, could have run a business in your own direction and own confinement, right? But there is an external person coming and sitting in the cap table,
Yeah.
in a shareholding, right? And he may sit in a board also. So you should be open and willing to hear him. So that is the first level thought. Second, so you need to have a mindset to dilute also. Coming to the valuation, I see there are a lot of many of the SMEs compare themselves to the tech startups, and they think those guys, somebody who has got zero, maybe negative EBITDA is getting $1 billion valuation, and where I show something, so they basically kind of sometimes compare that, and so they should be aware of the different set of investors, different set of businesses also, because in tech, given all the risk, the scalability is quick is what investors think, and they have proven also in many of the cases. In manufacturing, the scale is always against capital. You put 10 crore a line, then you're able to build a 20 crore business. For the
Hmm.
next 20 crore, you have to again put a 10 crore. So scalability is always an asset turnover ratio. right? So there is difference between them. So we have to have some awareness. So in my, if you ask me, you should be prepared and be aware of these nuances of external investment coming in. Risk is, if you're not prepared, then the entire investment will go for a risk.
Hmm.
The risk is that if you don't understand there are nuances around it, there are expectations around it, then it becomes a complete expectation delivery gap. Then you get stuck there, right? You need capital, but you bring capital that you can't give exit, and both of you are stuck. More importantly, take the investment from the right set of investors, culturally fitment, because most of the SMEs are more family owned. They have to have a culturally fit investors. If somebody is asking a very high growth business and you're not culturally fit, don't even take that money. Look for culturally fit investors. That is good. So be prepared for it. Once it preparedness is there, I think then you get a capital. And why should you be an SME for life, right? You actually can become a very large company, get an exit and unlock value for you and the entire family also, and the employees.
So we have been speaking a lot about the tech startups and tech companies, right? Where do you consider this AI is coming in?
See, AI and AI is almost cutting across all the industries, right?
Yeah,
So the basic fundamental stack is always available, right? And it's not a new one. For instance, the visual AI, conversational AI has been there for the last 3-4 years. So the fundamental stack is always available, and it is going to be available. So if anyone is able to use the AI very specifically for their existing domain and solve a large impact problem, so then I think there is a solution. Otherwise, you also will become one more clone.
of course. Why I asked this question is before a couple of years, most of people were telling about SaaS products, and most of the people were selling SaaS products. But nowadays, whatever the SaaS product they have, they just add AI inside the basic template they add inside and sell it as AI. Is there an actual change in the mindset of investors that AI startups get sold faster than the normal SaaS startups?
No. That is, see, if there is a potential to add AI, if you're not adding it, then it's an issue.
Okay.
Okay, so that we should be, if there is a, because AI has become like a fundamental value driver, right? So that is something which you have to understand. But if put AI for the sake of putting AI and there is no value, then I think investors are extremely mindful about it, right? For instance, it has happened like exactly said. I think few years ago, people call them platforms. I have seen a lot of pictures like platforms. Then there was a wave of neobanks coming in. Then there was a wave of lending companies coming in, because people think investors want to see that particular keyword and then getting attracted to, as a hook for it. It's not like that. Never like that also. Because see, they maybe in the first discussion they may get hooked to that particular term and they speak to you, right? If they don't see value in it, there is no point in doing it. Rather, you actually miss the opportunity to kind of crack a deal just putting some AI on top of it. Number one. Number two, if your business has a potential to imbibe AI, and if you're not doing it, then it's a completely non-negotiable thing that you actually have to put it. Like you said about the SaaS, right? A SaaS company, assuming it's an ERP, maybe adding a layer on that ERP makes a particular ERP more intelligent over a period of time, and you missed it because you're not being open for it, then it is a clear issue. But you just putting AI without having any application is something which is not going to be useful for anyone, neither the investors. So it's like a trend, right? Like what you're asking is that putting AI is like a trend, so everyone putting it, right? Yeah, today even a manufacturing company, when I get the thing, they say AI enabled and all these things, right? So um, you know that is okay. Now we both now speaking and writing emails also sometimes I use AI. Doesn't mean that we both are AI enabled companies, you get me, right? So AI has to be real application with a tangible outcome, both for the business and also the one which are delivering. Then I think it's meaningful. Otherwise, usage of AI is something like using your Wi-Fi for your company, right? So it has become like a very basic commodity. You should have a tangible outcome, and just putting AI doesn't really get a hook. I think investors are they're very extremely smarter than that, right? Yeah. So that doesn't help. Yeah.
That's great. So, in the past decade, we have been seeing a drastic change in the number of startups who are coming in. So previously, who were thinking about the career development in terms of entering inside a company and getting a job, nowadays people are thinking about getting outside a college and getting started with some
Yeah.
startup idea and getting investment. So in a term, it is becoming fancy, but in a way, we see a larger number of similar products coming in the same vertical, right? I'm having a basic customer's nightmare. So previously, if you ask me 5 or 6 years before, I would have a basic emotional touch for any brand that I'm taking. For example, if I'm getting a phone, I might get a Samsung phone. If I'm getting a water bottle, I might get a Tupperware water bottle. But now, as the days goes, as the startups come in, I'm getting multiple variety of what
Option.
can I say, products under the same vertical with the multiple different companies providing it. Is it a bubble that's going to burst at any point of time? Because before 5 or 6 years, the number of DPIIT approved startups was somewhere around 50,000, but now it is within last 5 6 years it's turned around 1.5 lakh or so. So, do you think, uh, in what sense, as a customer, do you think will it end at some point of time, or will customers' perspective change at some point of time, or will our Indian fund houses uh, stuck without investment at some point of time?
That's a very valid question. So, see, I think let's look at the customer perspective. First of all, I think it's good for customers in that way because you have got multiple options. The problem is that too many options is a problem for you, right? You have
Hmm.
a five versus one is a good option, but 50 versus one is a real problem because you have a problem of
Of
many here,
course.
right? So it may look like a good problem to have, it may confuse you also, right? So that way. But from a customer perspective, what has happened currently? Let's take a very simple example of consumables, right? Consumer products, maybe yeah, yeah, skincare consumer or a eatable, something of that sort, right? 2 decades ago, brand only sells because the brand was equal to quality.
Hmm.
Today, it's not like that. Even a small startup which is actually claiming to have a healthy snack, perhaps is producing equally a good healthy snack like an established company because for them access to resources have become easier. If you have to make a soap, if you have to make a chips, potato chips, right? There always was a requirement of a minimum size. So it was only a large company which was able to get into the soap manufacturing. Today, a bunch of people actually can do a handmade soap, and handmade soaps actually may sell better than the other soaps because there is a value add and things like that, right? Positioning is very different. So that actually in a way good for consumers and also for startups also because there is more startups that can come. The problem is the scale and the choice you take. Many of the startups may stuck, and if they don't scale, if they're happy about the choice, that's fine. But somebody has taken external cash, or somebody has got an idea that they will become very large and have burned the cash, will suddenly exit. That's the bubble you are speaking about. Today, what actually happens in the Amazon marketplace? There are four handmade soaps which topped, and people saw, okay, soaps are really selling, right? So maybe then 100 kind of soaps followed that. Maybe there's a market available because India is such a large market, possible. And maybe you can actually open the same soap to the other markets looking at the e-commerce marketplace, possible. But not everyone will become the top 10 unless you have the mindset to do that, right? That's what I asked about, pushing people to take a piece of paper to do this particular exercise. In this
Mhm.
exercise you can do even if you're a 10-year-old company, whatever I said. Today, the structure which I'm applying is not for the 0 to 1 companies, 1 to 10 companies. I have also speaking to people who are already done 20, 30 crores revenue, also are doing the same exercise. Because it's a fundamental problem for the next level of growth. You get me, right? So for a customer side, till the time you have enough opportunities, it's only it's actually customers. It's a good for customers, right? It's basically many customers have the options. Mobile becomes problems of many, automatically kind of no bounce up, right? Because just a matter of time, the extra bubble will anyhow burst and will actually again shrink to a viable company which actually can still produce and sell, right? So I think market will take care of itself.
Precisely, you said so. Uh, so, finally, but not least, what impact does stay still and scale high create for a SME or for a founder who has already attained one? And how do you handhold them to the next stage?
Yeah. So, thanks for this because so far it is always about other startups. So I myself a startup founder and I'm actually running a startup in a way, right? So It's about 6 months now since September. So first 3 months was more about settling things, and they had a clarity about what to do. It was about settling things, speaking to people. Like exactly I was saying, till the time you deliver something pro bono, it's very difficult, very different. When you ask money, it's a very different thing. You have to have a very
Mm.
tangible outcome, right? So for first 3 months, I was testing and teasing the market. The last 3 months have been extremely eventful, and have been extremely good learning. So broadly, I still do two things. I think I have done around 10 the last 3 months, 10 deep mentoring sessions, mentoring startups, right? It's not about running workshops. I'm just saying I've engaged 10 about 10 clients with a deep mentoring at the various stages. I could have gone with them from a very stage of building the entire execution blueprint and then taking to the funding also. Or somebody is already ready, I refine them for becoming investor ready and take them to funding. Or somebody is happy with that particular thing, they don't want fund and they just wanted to bounce off with me, have a clarity and go back. So about 10 15 examples I have. And SMEs have just started touching. So far it has been more startups. The 3 months I could because of the networks I had, I had more of startup ecosystem coming in than the SMEs have just started touching now. I'm now running workshops and reaching out to a few of this industry ecosystem players for running awareness programs. So I think next time when we meet after a period, maybe I'll have more stories about SMEs also. So if you ask me, I do three broad things. One, like I said, I run this high growth workshops and mentoring thing, help them become investor ready so that they understand the very good clarity about what are they getting into, who is the
Mm.
investors. It's not about money. It's about you becoming ready and also becoming taking advantage of the investment. Third is about I also help them to raise investment, right? So this are the on the thing. I also visit campuses and I am also mentored to many of the incubators where I get exposed to the 0 to 1 the problems which you spoke. Where it's more like getting exposed, getting being in touch with the young minds. It's always exciting to hear to young minds. So I go visit the campuses like these schools and technology institutes run practice-led entrepreneurship course. None of my courses have got books. There is an academic book. I push them to come with their own idea, or I then make them to tag along with the existing startup founder, push them to make a pitch, push them to build a business plan, push them to go for an actual pitch with an investor, get a real-time feedback. They may come get into the particular startup immediately after 5 years down the line, but at least they get a sense and taste of entrepreneurship during that particular course. So that is something which I do, and that gives a lot of joy for me and also learning for me. When I speak to people, when I hear young minds. So that is keeping me busy.
Right. So considering me as a founder, why should I consider Navanitha Krishnan as my mentor?
Yeah.
Other than any other incubators who could do the mentorship for me.
No, I think it is not about excluding. Even I actually, when I take somebody, take them to incubators. For instance, as we
Okay.
speak, one of the
Hmm.
medtech startup which I found is good for an incubator. I ensure that they meet an incubator, and I facilitate the incubation also. Now they are getting
Okay.
incubated. So I actually work with the ecosystem. I'm not exclusion for it because incubators have their own benefit that they bring to the table. Because they have access to grants also, right? So that I can't get. So I ensure that if they're
Right, sir. So we have come to the conclusion of this
yeah,
podcast finally. And
yeah,
firstly, we have learned. I'll give us a brief summary about what are the things we have covered in this. And if you want to include something else, you can include. So firstly, we cover about what stages the startups should cover, starting from idea stage. How should a survey be done? And what is the investment? What are the types of investment that he should consider? At what stage he should consider? And secondly, we covered about SMEs. Where usually SMEs fail and where usually SMEs has to seek for investment, and what is a P, what is a VC, and where the angel investment strategy, everything comes inside. And of course, stay still and scale high. It's a lot, sir. Actually, to say this is going to be a pro bono that you have done for an 1.5 hour session freely for all
yeah,
the listeners. Thanks for
yeah.
that, sir. Thanks for being here.
No, no, it's always a pleasure to be in such forums, Elavarsan, because you guys are doing a very good work for the startup ecosystem. Not only startup, I would say entrepreneurship ecosystem, and it's I think like I said, it's almost like a nation building effort. it's almost like building bridges and building roads and airports also, right? Because these entrepreneurs are going to really are the growth engines for the future economy and also for job creation. So I feel it like a responsibility to be part of such forums also. Yeah. So and thanks for making it.